they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutsky from the law firm of Cushing & Dolan with your Financial Exchange Quick Tip of the Day. And today we're talking about your new guide, Todd, demystifying the top 7 estate planning trusts. If there are younger families out there, should they consider having a trust in place, and what type?
Most people don't think about it when you're young, but if you're a young family, meaning you've got minor children, you might not have a ton of assets yet, but you want to make sure that what you do have is protected for your children. You could probably use a revocable trust. I don't think you need an irrevocable trust, but a revocable trust. You put your assets in. Again, they're going to avoid probate. Again, it may or may not be a big estate tax issue at the moment, but whatever you have, your children can own, right? They are minors. So you don't necessarily want to leave your assets to a guardian and have the guardian deal with everything when you can design a trust to hold the assets and ensure how and when and where and why they get these assets. Just pick the right trustee, put the language you need in the trust to control it for those children, and the trust will accomplish that task. So just because you're young, folks, doesn't mean you shouldn't think about your estate planning. Sometimes it's not all about the money and the probate and the taxes, but more so about the family behind the estate plan.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they have written a brand new guide called Demystifying the Top 7 Estate Planning Trusts. Call right now for your free copy, 866-848-5699. That's 848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck, Mark, and not Tucker with you today, and we kick things off here talking about a piece from the Bloomberg. The piece is titled "Bets on Outsize Fed Cut Gains Steam as CPI Data Backs Doves." I'll read a couple little quotes from here. A largely benign U.S. inflation report is bolstering the case for traders that the Federal Reserve will soon cut interest rates, with some seeing an increased possibility of an outsized reduction. For weeks, investors have piled into swaps, options, and outright Treasury longs to wager that subdued inflation will allow the Fed to lower borrowing costs in the coming months. There's some vindication for that view, with shorter-term Treasury yields dropping for the second day on Wednesday, while swaps traders lifted the odds of a September cut to more than 90%. And you've also started to see some ideas popping up that the Fed may cut more than 25 basis points in September, which leads me to kind of question what everyone is looking at. And here's, I guess, where the rubber meets the road for me, Mark. I think that this inflation report, as I look at it, can be described as warm, but not concerning to the point that there's, something truly horrible happening from an inflation perspective. And what I mean by that, the 1 month numbers, if you annualize them, came in for overall inflation at 2.4% annualized. I think we'd all be pretty happy if inflation ran at 2.4% per year. I think that's just fine. There's nothing wrong with that. Is it 2%? No, but we've talked about this before. Inflation wasn't 2% in the 90s, and the 90s were a darn good decade to live in economically, and so things were fine. We'd be happy with 2.4%. Core inflation came at an annualized rate of 3.9%, which I think we can look at and say we would not be happy if we saw inflation running just under 4% year over year, which is what the core number suggests is, hey, absent a 10% decline in energy prices, which is what we've seen this year, you'd basically be running close to 4% inflation if this, were to come through month over month or month after month. And so you'd be unhappy with that. Core inflation ex-shelter comes in at 4.8% annualized. Ex-shelter and used cars also at 4.8%. Core services ex-shelter at 6.8% annualized. And so basically what you see there is that aside from gas prices coming down during the month, which you just can't count on month over month, inflation was running meaningfully above the 2% target. The other piece that I look at then, here's the trend in annualized rates for all of these numbers over 1, 3, and 6 month periods. So overall inflation headline came in at a 2.4% annualized rate for the month of July. The last 3 months, it's been at a 2.3% annualized rate. In the last 6, it's been at 1.9, which means there's been a steady uptick in the pace of, headline inflation then. Not huge, not crazy. 1.9 to 2.4, I think we'd be happy anywhere in that range. Core inflation has gone from a 6-month annualized rate of 2.4% to a 3-month annualized rate of 2.8 to a 1-month annualized of 3.9. Again, increasing. Core ex-shelter has gone 1.9 to 2.8 to 4.8, increasing. Core ex-shelter and used cars, 2.2 to 3.1 to 4.8, increasing. Core services ex-shelter, 2.7 to 3.9 to 6.8, increasing. I guess this is all my way, Mark, of saying, hey, yes, this inflation report didn't print anything that was, dramatically out of line with expectations, but the expectations are also at a pace that is higher than I think we would all be comfortable with, and I think you could still make a case that, hey, if we get another bad jobs report in early September, you could certainly make a case that the Fed should still be cutting them, given, how they've approached the dual mandate historically and even in the last few years. But the idea that, hey, yesterday's data was, a slam dunk to move forward with rate cuts, I don't know that necessarily hits home with me. Your thoughts?
Well, what you ought to be looking at, and there's really no excuse for the media not reporting on measures that trim outliers, no matter where those outliers in the expenditure categories come from. Let me back up and say inflation is a composite. It's an average. There are a lot of different what are called expenditure categories. There's transportation. There's shelter. You talk about a lot of them, you and Mike Armstrong on the show. The average expenditure category increase month over month is inflation. There are good measures out there that trim extremes every month and do a better job of getting at the trend in inflation, aka underlying inflation. We talk about those sometimes. Median, which is just an extreme form of trimmed mean. And we all know the concept of median. You look at them, it's literally the one in the middle. You look at median home prices, you look at median salaries, because we all know that averages get distorted by extremes.
We don't care how much Jeff Bezos makes because most of us aren't Jeff Bezos.
That's what I was just going to say. I was going to use somebody else, but yeah, that's exactly what I was just going to say. So we all know the concept of median. As it turns out, it's more than just common sense. The median is robust, and that's a technical term, but it's just a fancy way of saying median doesn't get head faked by the occasional extremes month to month, the way that core ex-food and energy can. So a long-winded way of getting at my point here, which is researchers have known for a long time, like 3 decades, that median and other trimmed measures are better ways of getting at the trend in inflation. So where's the median right now? Where's it been last 6 months? Well over 3. Inflation's elevated. It's way above the Fed's goal. But to your point, Chuck, the Fed has, in the modern era, in anticipation of slowdowns, cut rates no matter where inflation was relative to target, because they view the greater risk, maybe the greater penalty, the greater stain on their reputation, or the greater political fallout coming from rising unemployment as opposed to slightly uncomfortable inflation. I think you're absolutely right.
Now, the interesting thing to me on this is there are 2 interesting things, actually, to me. The first is, what does this way of looking at inflation mean for equity markets? And as an example, let's say that I run a business and I sell a product for $100 and I make $10 in profit. So I have a 10% margin. Now let's say that inflation hits and my costs go up, but I also want to maintain my margins. And so now, hey, my costs went from $90 up to $99 because there was a 10% rise in my input costs. But I'm pretty sure that I can pass that on. And so I say, you know what, I'm going to sell for $110. My margins are still 10%. I'm getting $11 in profit off of $110 in goods. But my overall profit just went up by 10%. I just went from making, all else being equal in terms of volumes and this and that, I just went from making $10 an item up to $11. My earnings are going to be looking good. Like, I'm going to be feeling pretty good about this. And so ultimately, if you think about stocks from the perspective of, again, just something like price to earnings multiple as an example. Let's say that my earnings per share in this example were $10 and now they're $11. Hey, my earnings just went up by 10%. All else being equal, my stock price should move up similarly in order to be similarly valued. Yes.
Don't contract due to inflation.
That's why I said all else being equal,
Fair point.
And so here's the thing. Inflation is not the thing that usually kills stocks. What usually kills stocks is the response to inflation, because we say we need to beat the bag out of inflation because inflation is death for politicians. It is. It is. People just don't like it. It causes social unrest, and generally the people that are in power when that happens end up being voted out or in. You disagree?
Well, I'll just go with what the textbooks say, which is, only because I was reading this recently, it's top of mind. High and volatile inflation, and that's pretty rare, right? We haven't had a high and volatile inflation episode.
Continue. We have to get to a break.
Oh, sorry. Well,
no. Keep talking. Keep talking, Mark.
Is associated with investment uncertainty, growth uncertainty. These things are bad for growth, and thus.
But people don't like them. Ultimately.
Yeah, well, I was going to connect the growth to stock prices.
When it comes to inflation, people don't like it. It's the only thing. If you have $10 now, and all of a sudden someone gives you $11, but you can still only buy the same things, you're not worse off. But people are like, this sucks.
Yeah, I was going to connect it to economic growth. So higher inflation is associated with lower economic growth, so the research finds, which is associated with lower earning. I mean, you might get an initial pop, like some episodes of hyperinflation have translated into higher equity prices off the bat.
Sure.
But that erodes pretty quickly, and you get everything going haywire.
But generally, it's because our response to it is to, hey, we got to beat the heck out of this.
You're talking about the U.S. experience.
Right. You think about
the
reason why stocks get pounded in the U.S. because of inflation is because we say, okay, we're going to raise interest rates in order to fight it because we don't want it here. No one likes it. No one enjoys inflation. Talk to anyone over the last 5 years. Did anyone have a good time in 21 or 22? Not really. Everyone was like, this kind of sucks. This is brutal. And so the interesting question that I think is out there to me right now is, look, if we actually have a Fed and a Treasury and just an administration that is going to say, hey, it's okay if inflation is printing 3% or 3.5% annually, how do we have to recalculate how we think about equity markets, bond markets, and what it means for them? Is there a rethinking that we need to do? Let's take a quick break, and then we'll talk about that a little bit more when we return.
Tariff fever is in high gear. We've got the latest on what might be next and how long it might last. Only here on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. When it comes to legacy planning, having a will is important, but it may not be enough. A will only covers probate assets, and the probate process can be slow, public, and expensive. That's where trusts come in. Trusts can help you avoid probate, keep your wishes private, and control how and when your assets are distributed. Whether you're looking to support family, minimize taxes, or prepare for the unexpected, a well-designed plan can make a meaningful difference. Our new free guide, Leaving a Lasting Legacy, covers wills, trusts, and other strategies to help you build a strong retirement plan. Take the first step towards clarity by calling 800-393-4001 right now and asking for your free guide today. That number again is 800-393-4001 or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Cushing and Dolan know that no two families are alike, and neither are their estate plans. If you want a stress-free retirement, early planning is key. And for many, trusts are the tool of choice to protect assets and minimize taxes. But here's the challenge. There are dozens of trusts out there, revocable, irrevocable, and each comes with different rules and tax implications. From family trusts to special needs trusts, creditor protection trust to charitable trusts, each serves a different purpose. Knowing which one fits your situation can make all the difference in your plan. That's why Cushing and Dolan put together a brand new guide demystifying the top 7 estate planning trusts. It breaks down the most common trust options so you can decide what's right for your family and your future. Call 866-848-5699 right now and ask for your free copy or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing and Dolan. Cushing and Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Text us 617-362-1385 with your comments and questions about today's show. This is the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts, and now's the perfect time to register for this year's 5K at Castle Island by visiting dav5k.boston. The event will sell out again, so if you're interested in participating, now's the time to reserve your spot. Come out and help support our great American heroes by joining us for the DAV 5K. Visit dav5k.boston to register or to make a donation today. That's dav5k.boston.
In the last segment, I mentioned there were two interesting things that I wanted to talk about as it relates to just how we're talking about inflation and potential rate cuts right now. The first was, look, you had an inflation report yesterday that was still hotter than the Fed would like to see, and all it did was solidify support for rate cuts in September. Jim Bianco of Bianco Research points out the only time, and granted, we don't have a huge sample size here because inflation's generally been pretty tame most of the last 40 years. The only time in the last 45 years that we have had the Fed, if the Fed cuts in September, it'll be the only time in the last 45 years that the Fed has done so with core inflation above 3 and having increased 0.3% or more over the last 3 months. So core inflation 3 months ago was 2.78. It's now 3.05. This would be only the second time that the Fed would be cutting in those circumstances. The only other one was during Gulf War in 91 when the U.S. economy was entering recession and clearly things were very dodgy then.
Yep, that sounds right.
So we're in a period now where the Fed seems to have given the okay to, hey, core inflation's at 3 and we're going to cut rates, which really raises the question of, is that 2% inflation target dead? The subsequent follow-up that I have then, and this is the second part that's interesting to me, is, Mark, what's the conventional wisdom on why rate cuts are stimulative to the economy?
I am a good conventional wisdom foil. Well, they work through what a researcher would call aggregate demand, total demand. The Fed has an impact on the real economy because it can print. I'm going to oversimplify a little bit here, so you tell me if this sounds stupid. Fed can print money and shove it into the economy. I'm ignoring the mechanism of interest rates, which is what they currently target. And when they do that, initially, demand is. Why don't prices go up?
Why does demand go? Tell me how.
Some prices don't move right away. You think everybody would just move their prices. And there have been economists have a few different models for looking at this. I'm not going to get into each one, but suffice to say, prices are rigid in the short term. Maybe it's because people don't recognize that the Fed has just fire hosed a lot of money into the economy.
How do they fire hose the money? Why tell me though, what actually happens? Why does the Fed cutting rates put more money into the economy?
The short answer is they lower the federal funds rate by flooding the banking system with reserves. That allows banks to
what does that do
to one another. It lowers short-term rates and allows banks to lend more money at lower rates, I think is the short answer.
How do they lend the money? How do they lend the money at lower rates? Where does that come from?
Literally, banks loaning it to borrowers. Maybe I'm missing the.
How does that get priced in, though? Are we talking short-term rates move, long-term rates?
Well,
what happens that allow because banks, when we talk about a 30-year mortgage, banks don't price a mortgage based off the Fed funds rate.
Yeah, which is why I wouldn't use the 30-year mortgage in this example. You don't know what longer-term rates are going to do in response.
So, what types of where's the demand come from these lower rates? What types of products?
Investment. They're really trying to stimulate investment and therefore demand.
But even there, it still isn't. Companies just borrowing. Companies don't borrow overnight.
No, banks loan to each other, so it lowers their cost of capital, and they're able to pass that along.
But typically where this ends up being reflected is somewhere on the yield curve, because companies have to borrow 5-year business loans, 7-year business.
You see
companies don't borrow overnight is what I'm getting at.
Right, but go ahead, sir.
Here's my question on this. Let's say that inflation is settled in at 3%. Let's say that 3% is the new norm for inflation. I don't know if it is. I don't know if it isn't. I got 5-year U.S. Treasury bonds right now sitting at 3.7%. If I wrap my head around the fact that inflation is anchored around 3, which it may or may not be, it might be higher, it might be lower, I don't know. Am I cool lending to the U.S. government at 0.75% above the inflation rate and calling it a day?
Well, markets are. You and I may not be. I'm not. But
markets might be right now. I guess what I'm getting at is, have markets actually internalized this yet?
No, 5-year break even, which you can infer from inflation protected treasuries, is 2.4. So markets are expecting according to this measure, again, it's an inference, 2.4, not 3%. I think it's higher, like you said. But markets don't seem to think so using this gauge.
So here's the interesting place that I guess my head goes on this. And I don't know if this is right or wrong. It's just as I try to think about it as, someone who might need to, hey, I've got money sitting in the bank. What interest rate am I comfortable getting over what period of time?
Yeah.
If the Fed is saying that they're cool with inflation at 3%, which a cut in September implies pretty strongly, what do I need to return over 5 years, given the fact that, hey, if inflation's centered around 3%, there's a decent chance over 5 years it could be 2. There's a decent chance over 5 years it could be 4. And so if that's kind of the new place that we're anchored, what does it mean to the Fed's ability to actually move interest rates beyond the short-term rate when they start cutting? Do we have something where, okay, if we think the long-term real growth rate of the U.S. is still in that 2% range, and inflation's now anchored around 3, so we're in, again, kind of a 5-6% nominal world, am I cool just getting 3.75% on a 5-year treasury? Am I okay with that? And if not, if the long end moves in the opposite direction that the Fed's expecting, does the Fed actually stimulate as much as they have in other cycles if longer-term rates aren't moving down? That's kind of my question.
Yeah, we should talk about this after 11, yeah.
Take a quick break. When we come back, we got Wall Street Watch and Ask Todd next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a new guide available this month titled Leaving a Lasting Legacy. Mike, when it comes to naming beneficiaries on different accounts, what's the thought process that people should be starting with?
Well, first and foremost would be probably you want to do it. I know that seems so basic, but Chuck, I mean, how frequently do we run into this where forget about your investment accounts. Usually those are getting looked at. Your 401k, it's one of the first things you get asked. But I run into people every day that don't realize they can have beneficiary designations on bank accounts, for instance. And what an easy way to avoid frustration after you're gone.
Can you talk a little bit about how much time and effort that can save someone after a loved one passes away when it comes to being able to inherit assets quickly?
Anyone that's been through probate will know the answer to this, but these things can last a year, and it doesn't matter if it's a $5 million estate. Obviously, that's pretty complicated, but a $10,000 checking account could also need to go through probate, and it could take an equal amount of time depending on the complexities involved. And so there are a lot of benefits that are out there when it comes to just utilizing the tools that are made available to you, and beneficiaries is a big one.
Folks, the guide is titled Leaving a Lasting Legacy, and the way to request it is by calling 800-393-4001. Again, the guide is titled Leaving a Lasting Legacy. It discusses beneficiary designations and a whole lot more. And the way to request it again is by calling 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are on the rise today. A lot of green on the board right now. The Dow Jones is up 0.6% or 273 points. The S&P 500 is up just under 0.2% or 11.85 points. And the NASDAQ is up 32 points or 0.15%. Fast casual restaurant chain Cava is down 16% after revenue came in at $280.6 million for the second quarter, missing the consensus forecast of $285.6 million. The company also missed expectations for same-store sales and lowered its forecast. However, Cava earned 16 cents per share in the quarter, exceeding Wall Street's estimate of 13 cents. Artificial intelligence infrastructure provider CoreWeave is down 15%, despite it posting better than expected revenue for the second quarter. During an earnings call with analysts, the CFO said that revenue growth remains capacity constrained as demand outstrips supply. Circle shares of the stablecoin issuer down 4%. Circle said that it would offer 10 million Class A shares to the public, including 2 million of which that could come from the company itself. Chile's parent Brinker International is up 0.7% on better than expected earnings beat for the fiscal fourth quarter. Brinker earned $2.49 per share, excluding items on revenue of $1.43 billion. Analyst survey expected a profit of $2.45 per share on revenue of $1.39 billion. Hanes brand shares are down 5.5%. After surging around 28% in Tuesday's session, Hanes brand said it agreed to $4.4 billion takeover deal by Canada-based Gildan Activewear. The Financial Times first reported on the deal yesterday. And finally, Palo Alto Networks' stock is up 0.7% on the heels of a Deutsche Bank's upgrade to buy from hold. Deutsche said Palo Alto has solid core business and management. I am Ben Kitchen, and that is Wall Street Watch.
This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
As promised, Todd Lutsky from Cushing and Dolan joins us now live on air. It's your chance to ask him your estate planning questions live on air, which is why we call the segment Ask Todd. Studio lines are open at 888-205-2263. That number again is 888-205-2263. Usually can get through 2 to 3 calls, so get calling early and often if you want to make sure we get to you. Again, that phone number is 888-205-2263. One more time, it is 888-205-2263. Mr. Lutsky, how are you doing today?
I am never better. How are you?
Not great.
No, it's always something with you.
Well, wife says she's considering a divorce because I care more about sports than our marriage.
Oh, yeah? Well, do you?
Well, here's the thing. We almost made it through 7 seasons.
That's true.
So there's that.
Yeah, there's that.
Todd, I want to talk to you a little bit about what's going on when it comes to estate planning and estate taxes. How do trusts help to mitigate issues with estate taxes, either at the state or federal level?
So it's funny. I was just meeting with a client, and they're always wondering, what we always hear that we should be doing this. We hear it, but we haven't done it. And these folks come in and let's say they're worth, it's about $18 million. Well, yeah, we should be doing it, right? And remember, it's giving away free money if you don't do your planning is really what it comes down to. And you're making a gift to the state in a lot of ways. So that's the first much is taxes. That's what you're asking about. So now federally, for a lot of people, it might be, well, no, it's not a big deal, right? Because the federal exemption is at $13.9 million. It will soon be $15 million come 2026 under the new act that passed. But who knows? It's not permanent. We have a new president in the future. A new regime could lower the exemption. It's been all over the map. So you always got to be planning for whatever that exemption is to take advantage of it, because you never know what it's going to be when you die, but you want to make sure you get it and use it. And by the way, these exemptions are the amount of assets you can pass estate tax free. Go over this number and you got to pay taxes. If it's to somebody other than a spouse. You can leave an unlimited amount to a spouse, which of course is what they want you to do, because if you don't do planning and you die and you have everything jointly owned with your spouse, everything just passes to your spouse. Hey, that was easy. Yeah, but now your spouse has all the assets and it might be larger number than that spouse's exemption, and they don't mind waiting and they get to pay the tax on the survivor's death. So always want to grab whatever the exemption is on the first death to shelter as much as you possibly can. When I say shelter, it means whatever's in the trust, back to your point, Chuck, whatever's in the trust that's potentially taxed on the first death will not be taxed when the survivor dies. That's how we shelter it, so there's less taxed when the survivor dies. And on the first death, it's always designed to never exceed, the shelter never exceeds whatever the exemption is. So there's never going to be any tax on the first death. Now, having said that, federally you might be saying, yeah, Todd, so what? It's a big number. What about Mass? Massachusetts only has a $2 million exemption. You could have your home alone could be $1 million, right? You could have a life insurance policy for $1 million. You're at $2 million and you only talked about 2 items. So it sneaks up on you, right? So at some point you have to realize the trust will also shelter the same way I discussed it for Fed. It shelters for Mass, the $2 million, so that the survivor, if they're worth less than $2 million, no tax. So on a $4 million Massachusetts estate, more reasonable, right? More like, hey, that's me. I can eliminate Mass tax with basic estate planning using trusts on $4 million. So there are good reasons to do it, Chuck.
Talking with Todd Lutsky from the law firm of Cushing & Dolan. This is your chance to ask your estate planning questions live on air right now. Phone lines still have some room at 888-205-2263. That number is 888-205-2263. We're going to take a quick break here, but when we come back, it's going to be right to your questions with Todd Lutsky. Again, still a little bit of room, so get calling at 888-205-2263. One more time, that number is 888-205-2263.
Miss any of the show? The Financial Exchange Show podcast is available on Apple, Spotify, and iHeartRadio. Hit the subscribe button and leave us a 5-star review. This is the Financial Exchange Radio Network. Cushing and Dolan know that no two families are alike, and neither are their estate plans. If you want a stress-free retirement, early planning is key. And for many, trusts are the tool of choice to protect assets and minimize taxes. But here's the challenge. There are dozens of trusts out there, revocable, irrevocable, and each comes with different rules and tax implications. From family trusts to special needs trusts, creditor protection trusts to charitable trusts, each serves a different purpose. Knowing which one fits your situation can make all the difference in your plan. That's why Cushing & Dolan put together a brand new guide demystifying the top 7 estate planning trusts. It breaks down the most common trust options so you can decide what's right for your family and your future. Call 866-848-5699 right now and ask for your free copy or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. When it comes to legacy planning, having a will is important, but it may not be enough. A will only covers probate assets, and the probate process can be slow, public, and expensive. That's where trusts come in. Trusts can help you avoid probate, keep your wishes private, and control how and when your assets are distributed. Whether you're looking to support family, minimize taxes, or prepare for the unexpected, a well-designed plan can make a meaningful difference. Our new free guide, Leaving a Lasting Legacy, covers wills, trusts, and other strategies to help you build a strong retirement plan. Take the first step towards clarity by calling 800-393-4001 right now and asking for your free guide today. That number again is 800-393-4001 or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, Desi is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
This is your home for the most comprehensive coverage of the economy and the trends on Wall Street. This is the Financial Exchange Radio Network.
Alrighty, as promised, let's get right to your calls for Todd Lutsky. First up, we've got Phil on the Cape. Phil, what's your question for Todd?
Yes, Todd, more than 5 years ago, you made a irrevocable trust for me. And now my question is, if I get cryptocurrency or gold bars, can I put that in the trust, or do I have to make a new trust?
So I'll answer it this way. Yes, you can put any kind of investment you want into these trusts, whether it's gold, crypto, stocks, bonds, real estate. It can be added to the trust, titled to the trust. I do that for almost all assets. I help you do that. So it will create a new 5-year waiting period, but only for the new addition that you're putting in the trust. It will not affect what we did 5 years ago. My last caveat to your question is, well, yes, you can put crypto and gold in there. I am not sure how you transfer crypto to the name of the trust. But if you're involved in crypto, maybe you know how, and we can get whatever paperwork you need together to do that. And so that would be the answer. So, yes, go ahead and contribute. And, folks.
Okay, but it's
Yep, go ahead.
You definitely have to put in a new 5-year waiting period.
But only for the
Not
new
the
edition.
same.
Only for the new edition. Okay? Excellent. And so, folks, that's just, and again, he's got the irrevocable trust in place, which is great. He's beyond the 5 years. That's just one of the trusts that we're talking about in our guide this month, which is the top 7 estate planning trusts. I've sort of over the years thought about what these are that I see most of the time, and I put together this guide. It tells you not only how they work from an estate tax standpoint, an income tax standpoint. They're irrevocable, they're revocable trusts in here. Medicaid, like the one Phil has, an irrevocable trust that protects from nursing homes. There's, special needs trusts if you have special needs children. There's even the dreaded nominee realty trust that a lot of people have but really don't understand because it's not really a trust. And it also explains the day-to-day operations of how they work to not, encumber your life in any way. So if you haven't gotten started in estate planning, this will help you get started. If you've gotten started, maybe you want to adjust the kind of trust you have. Something for everyone in this guide, folks. Call and get it, 866-848-5699 or legalexchangeshow.com. Again, top 7 estate planning trusts, 866-848-5699 or legalexchangeshow.com.
Let's stick with the Cape. Let's go to Dave on the Cape. Now, Dave, what is your question for Todd Lutsky?
Hi, good morning, Todd.
Hi, Dave.
I've got my wife and I have several $1 million in IRAs. What's the best way to protect that and pass it on to my kids?
So as a percentage of your overall estate, let's say several means 3, of your overall estate, how much is the IRA? Like, if you're worth $4 million, most of it's an IRA. That's what I'm trying to find out.
Yeah, the majority. I've got $5 million in IRAs, and my real estate equity in 2 houses is a little over $1 million. And that's like 95% of
your assets.
Besides equity in the house, 95% of our investments are in IRAs.
So $6 million estate, and how old are you?
63.
So your question is, how do you protect it from a nursing home?
No, I just what's the best way to pass it on to my kids?
Yeah, great question. So, and I agree. I don't think you need to be worried about nursing homes. I think you're probably self-insured when you talk about investing $5 million. The income that it generates alone will be helpful. But estate tax-wise, yes, we've got to avoid probate. We want to reduce significantly the mass estate tax, at least. Federally, you're fine. And so then the idea is, how do I leave this to them? Probably in your case, a revocable trust. Put the houses in now. Put the bank accounts in now. Leave the IRAs out for now. The designated beneficiary would be each other. And then the contingent beneficiary would be the new family revocable trust that we put together. So that ultimately this $5 million will get into the trust. Yes, it will shelter, allow us to shelter assets for estate tax purposes, at least for mass. Federally, again, it's doing it, but it's not critical. depending on exactly how much we can get into the trust while you're both alive, we may need to direct some of the first to die IRA to the trust rather than to the spouse. But that's something we would fine tune when we're together, or whenever you're working with whoever you're working with in the estate planning attorney world. You would fine tune that. But the beauty is, not only does it avoid probate and help you shelter the estate taxes, but with that kind of money, you can design the trust so that when you die, the assets are going to be sheltered for your kids from future creditors, future divorces. I mean, this is a big enough dollar amount that you might want to think about doing that. And so the trust can live on even after you die and really provide nicely for your family. So great question, and I think you're on the right track, but I do think you need to do some planning to save the taxes.
Got another one for you here, Todd. Let's go to Dale in Newberry. Dale, what's your question for Todd Lutsky?
Good morning, Todd. I'm 75. My wife is 62. We have a house paid for worth about $1.2 million, and we have $1 million in IRAs. My question is, am I in the need for a credit shelter trust?
So you're when you say, so let's look at $2.2 million estate, right? Well, Massachusetts, remember, is only a $2 million exemption. So yeah, I mean, I would want the credit shelter if I'm going to do a trust for you anyway, right? Which I'm going to ask you another question in a minute. But if I was going to be doing a trust for you anyways, I would want that trust to include credit shelter, Q-tip language, so that, again, 75 and 62, there's a long time before both of you are gone. And we want to make sure that on the first death, we shelter what we can, so there's no, not just reduced, but zero mass estate tax. So that would be yes on a credit shelter trust. And then lastly, I would just think about, well, if you both have kids or you're trying to leave assets to the next generation, you might want to think about the type of trust you do, which might be irrevocable if you want to protect the house from the nursing home, and maybe even some of the IRA from the nursing home a little longer. I don't have a discussion for that now, but there's a way to do both. I would think the irrevocable trust approach would be right for you, and yes, that trust would include the Q-tip language, so you can get asset protection and estate tax planning at the same time. So yes, you're on the right track as well, but I think you need to seek out a lawyer to get it done.
Todd, I got one more for you. We're going to have to be quick, but Peter in Worcester, what's your question for Todd Lutsky? Only got about a minute.
All right, Todd, thanks for taking my call. Real quick, I have a revocable trust. I'm 65 years old. I have two children that are basically named as in the will and the trust.
Mm-hmm.
My question to you is, I have a 457B plan that I was instructed by my lawyer to put into the trust as a beneficiary. The trust is the beneficiary for my two daughters.
Got it.
My question to you is that okay, or should I just basically name my two daughters as beneficiaries?
Here's the answer is really going to be up to you, and here's why. If you are saying, Todd, I'm okay with my daughters taking the money as they want to take it from over 10 years, just name them. If it's a large enough number and you're saying, I also want to make sure it's protected from creditors, future divorces of the kids, etc., then name the trust and have that language built into the trust. So it's really up to you how much it is and how much protection you think you really want for your children. So hopefully that answers the question, and I think we're out of time.
Mr. Lutsky, thanks so much for joining us.
Always a pleasure.
This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing and Armstrong do not endorse each other and are not affiliated.
Still more to come as we continue through the show. We'll be talking a little bit about artificial intelligence. That'll be fun, as it always is. Also, a little bit more on who the president may nominate for Fed chair. A little bit on the mortgage market. And also, kind of a little tangent there, older Americans trying to decide whether or not they should own a home or just rent We'll tell you a little bit about what's going on with some of the trends on that side of things. All that and more in hour number 2.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands. America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle. Just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com.
Hi, this is Chuck Zodda from the Armstrong Advisory Group. If you have an IRA, it's critical to understand the tax rules that may affect your family as you plan for retirement. Current law requires most non-spouse beneficiaries to withdraw the full balance of an inherited IRA within 10 years, which may lead to higher taxes and reduced value over time. If beneficiary designations are outdated or incorrect, they could possibly override your will and change how your assets are distributed. That's why we're offering a new guide called Leaving a Lasting Legacy, a resource to help you better understand inherited IRAs and other legacy planning topics that could affect your future. Make an informed choice and take control of your plan. Call 800-393-4001 and ask for your free guide today. That's 800-393-4001 or request your copy online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva with the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutsky from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your new guide, Todd, Demystifying the Top 7 Estate Planning Trusts. Now, do you lose control if you transfer your assets to an irrevocable trust in order to protect them from long-term care expenses?
Well, that's great when you mention that irrevocable trust, but limit it to the kind of trust where you're protecting it from the cost of long-term care. Because as the guide says, there's 7 different kinds of trusts that we're trying to demystify. And there's also many kinds of irrevocable trusts out there, not just one type. So many people think there's just one type. But this particular type, where you're trying to protect it from the cost of long-term care expenses, the answer is no. You do not lose control over your assets. There's a whole spectrum of control with irrevocable trusts. And this one, you keep about 95% control. Like, you can live in your house, you can sell your house, you can buy another house, you can invest your money, you can manage your money, you can collect the income. Even the tax liability of these trusts are designed to be at your own rate. In other words, they are grantor trusts. You don't even pay any higher income taxes when you have this irrevocable trust. So this kind of trust, folks, you keep control and you protect your assets from the cost of long-term care.
Call right now for your free copy of Cushing & Dolan's comprehensive guide titled Demystifying the Top 7 Estate Planning Trusts. It will help you determine what type of trust is right for you and your family. Call 866-848-5699. That's 866-848-5699. Or you can request it from LegalExchangeShow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck, Mark, and Not Tucker with you today, and stocks are kind of reversing what they've done for the last few months, not in terms of the overall trend, but what's driving this market. We got the Dow up 294 points, or about 2/3%. S&P is up 8 points, or about 1/8%. NASDAQ up 17 points, or less than 0.1%. And so what I mean is, look, the major driver for this market, in particular in the last 6 weeks, but really over the last 3 months, has been the resurgence of big tech. After struggling in the second half last year and the first quarter this year, big tech is back, and it's back big. But today, not really so much. You take a look at some of the names that are moving, and NVIDIA's down 1.25%, Palantir's down 0.4%, Microsoft down 0.25%, Google floating around 0, just not really moving anywhere. And so you end up in a situation where the S&P 500's up 0.1%, but you've actually got almost 200 more stocks in positive territory than negative. So kind of more breadth, but lackluster performance for the index today. We'll see how this evolves over, the next little bit, whether this is just a 1 or 2 day weird happenstance, or if this is something that develops into, kind of a new trend over the next month or two. 10-year Treasury is seeing yields moving down significantly, down 6.6 basis points today to 4.227%. And we've also got, in response to that, gold is up $13.50 an ounce, or about 0.4%. And for oil, West Texas Intermediate down 87 cents a barrel to 62.30. And so you've got oil prices falling into the low 60s. And despite that, AAA national average for gas prices, forgive me if you've heard this story before, it's at $3.15 and 5/10. We've been between $3.10 and $3.20 for the last 5 months now, with no definitive move in either direction. I want to kick things off this hour talking a little bit about, it's something called artificial intelligence, or AI is how people are referring to it. And I've never heard of it before, but it sounds fascinating. Artificial intelligence, I mean, man. So, piece in the New York Times, companies are pouring billions into AI. It has yet to pay off. And I think that by and large, this is fair, in that companies are spending a bunch of money rolling out data centers and models. And yeah, there's been some incremental revenue increase here and there, but certainly not to the extent of what they've poured into this. And so you're certainly seeing something where there's this need for businesses to continue to ramp up this CapEx on these AI data centers. Meta is now indicating they're going to spend $100+ billion on CapEx next year, which is just kind of mind-blowing when you think that, hey, 5-6 years ago, they were spending like $3 billion a year in CapEx, and now they're going to spend $100 billion. That tells you just, how things have ramped up for them. Granted, about, a decent chunk of that is still their metaverse project that they're doing. I think that's about $10 billion a year that they're trying to make Meta happen. But in any case, the question that is out there is, look, at some point, you have to prove that you can actually monetize this stuff and make money off of it. And I have a lot of friends that are way smarter than me, is I think the best way of putting it. Specifically when it comes to tech. And a lot of them work in tech and programming and different adjacent areas. And they are reporting that, hey, for, programming and stuff, it can take a ton of time out of the process. You still have to, supervise the code and basically make sure that, you're checking for things that would be security breaches or, potential problems and all that stuff. But it can streamline the code making process such that you're able to do a lot more than you used to, which I totally buy, because a large language model, as long as you train it on the language of the code, it should be able to spit out exactly those things. The question that I think is out there for a lot of other businesses is, okay, we don't do any coding beyond, that kind of stuff, or, hey, in law, document review and stuff like that, which you can use it for. Beyond those types of things, how does this have a bigger impact on our business? And so is the amount of money being poured into this justified, or are we going to be sitting here 5 years from now saying, wow, can't believe we did that. Let's move on and, see what actually is next.
I don't mean to snicker. Experimentation is necessary. I don't mean to snicker at Meta spending $10 billion a year on the metaverse, because something may come of that we can't foresee now.
No, I think we can say the metaverse, nothing's going to happen.
Yeah, well, you might be right. I'm just trying to be a little bit charitable and maybe a little bit humble, because I don't
we
really
make
get
fun
it.
of them for the metaverse.
Oh, we do? Okay.
We,
All right,
we do.
That's fair game.
The metaverse is Mark Zuckerberg trying to make Meta happen. And look, here's the thing on the metaverse. We've said this, time and time again. If you're spending $10 billion a year and you've got like 100,000 people using it, it's never going to happen. The stuff that's actually cool, people move to organically. The stuff that's useful, people move to. Look no further, by the way, than generative AI. There's a reason why ChatGPT has 700 million users. It's because people can actually find ways to use it in their life. It may not be perfect. I'm not saying it is, and I'm not saying this is a good thing either. But what I am saying is Microsoft and OpenAI didn't have to spend billions of dollars getting people convinced to use it.
Well, the marketing part of it could be a waste, yeah.
Meta's not spending any money on marketing the metaverse.
Like I said, they're not spending any money.
It's dead. Meta will not happen. But all this other stuff with generative AI, the question is, hey, how do you turn people who want to make, videos of cats surfing into actual revenue? This is the place where I keep coming back to is, hey, they don't want your $20 a month subscription for ChatGPT Pro. They want your company to spend $20,000 a year instead of having to pay a person $60,000 plus benefits.
And that's the trade-off companies are going to make. There's an anecdote in the article about Johnson Controls. Their field techs can get recommendation repairs from their new software, and it's cutting down on repair time anywhere from 16% to 25%, according to the anecdote. That's a miraculous.
Which is huge. That's
life-changing
great.
for these guys and for the company, too. How representative is that? I don't know. We need to think of our own experience with Microsoft Office. Those of us who are of a certain age remember when MS Office replaced separate Excel, separate spreadsheets. It wasn't Excel, obviously, but Word Perfect.
Lotus Notes.
And I was on Lotus Notes initially. I don't really notice to be honest, from Notes and what the heck was their spreadsheet? 1, 2, 3 was their spreadsheet.
Yeah.
I don't really notice the difference. There aren't many more functions for a user at my level in Excel now versus old spreadsheets. I guess my point is, I would be shocked if AI, which is a very broad term and means a lot of different things to different people, made us as and this is going to sound naive because it's contrary to what others like at Goldman have predicted AI will boost GDP by, economic growth by. We need to think, we can all think about, go through this little mental exercise. Do you think using Office a little bit more productively will make you more productive than the shift from whatever you were doing pre-Office, like a word processor with a line readout? People of a certain age will also remember those memory typewriters. That's what we used before word processors on a run on a hard drive of a computer. Do you think the leap will be as big as it was from a computer with a typewriter with a memory? As it to Office? The leap from Office to AI enhanced Office will be as big as that initial leap I'm describing that took place in the 80s and early 90s. I personally have my doubts, but I don't claim to be an expert.
The place that I continue to think, and I guess here's where I'm at after using these platforms quite a bit. I think there's an awful lot of use that generative AI can provide. Mm-hmm. I think a lot of times we might also use it in the wrong way, but we're humans and that's what we do. I mean, we're the people that eat Tide Pods because someone told us not to.
Because they're delicious.
They're not delicious, Mark.
Oh, sorry.
But we're people do dumb things because they're people. All of us do. All of us in all walks of life. We've all done stupid things just because we're human, and it's going to be no different with AI. But at this point, I'll be honest, I think there's almost a little too much skepticism that's creeping in with regards to AI. Every time that it produces a dumb response, someone posts it on the internet and is like, oh, see, generative AI can't do this. And I'm like,
no, that's not fair.
I'm like, yeah, I think it does some dumb stuff too, and I've done this as well. But ultimately, I've also found that it can be really useful for some things and save me a ton of time. So I think that we might be starting to underestimate some of the time savings in the white-collar world. But the other piece that I think is being dramatically underpriced is the rise of real, functional, useful robotics in the next 3 to 5 years. And I think this is a major theme that is coming. And the danger in this is that I do think for the people that are in the jobs that we've always said can never be outsourced, trades, things like that, agriculture, hospitality, I think there's some stuff coming on that side that has the potential to be hugely disruptive, and I don't think it's being priced into how we look at this over the next 3 to 5 years. And the implications that I have then are, hey, the reason a business is willing to pay for a cheaper head in the form of a robot or an AI is because they still can sell the same amount of stuff. If we end up with AI actually starting to replace some employment, what do you think happens on the demand side of things? And what, is it kind of this spiral where, hey, there's no demand for these services in the same quantities because the dollars aren't there in the rest of the economy? How do we manage that? That's more of a societal question than anything else. But these are ones that I think we may have to reckon with in the next 5 to 7 years. Let's take a quick break. When we return, we're going to do a little bit of trivia. And then, let's see. No, that's enough AI for now. Let's talk a little bit about Social Security when we return.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's the Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network. The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com. Cushing & Dolan know that no two families are alike, and neither are their estate plans. If you want a stress-free retirement, early planning is key. And for many, trusts are the tool of choice to protect assets and minimize taxes. But here's the challenge. There are dozens of trusts out there, revocable, irrevocable, and each comes with different rules and tax implications. From family trusts to special needs trusts, creditor protection trust to charitable trusts, each serves a different purpose. Knowing which one fits your situation can make all the difference in your plan. That's why Cushing & Dolan put together a brand new guide demystifying the top 7 estate planning trusts. It breaks down the most common trust options so you can decide what's right for your family and your future. Call 866-848-5699 right now and ask for your free copy, or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up because we have something better,
stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
Well, it's time now for trivia here on the Financial Exchange, and I think it's time for a new little trivia theme. So we'll do a little bit of World War II for the remaining few days here in August, and we'll kick it off with on this day in 1942. The Manhattan Project began under the direction of U.S. General Leslie Groves with the aim of developing an atomic bomb. Spoiler alert, it worked. The question today is, which actor portrayed General Leslie Groves in 2023's Oppenheimer? Which actor portrayed General Leslie Groves in 2023's Oppenheimer? Be the third person who texts us at 617-362-1385 with the correct answer, and you'll win a Financial Exchange Show t-shirt. The third correct response will be our winner. See the complete contest rules at financialexchangeshow.com.
Mark, we got a piece here from CNBC. Social Security cost of living adjustment may be 2.7% in 2026, new estimates find. And it's that time of year when we start to look at the projections for next year's cost of living adjustment for Social Security. The way that it is done, effectively what they do is they take the government inflation data from July, August, and September. So we just got July, and they average it, and then they compare it with those 3 months from the prior year. And the difference in the percentage rate, or difference in the numbers, is the percentage difference for the cost of living adjustment. And specifically, they look at the Consumer Price Index for urban wage earners and clerical workers, the CPIW. And this is across a couple different projections now. One from Mary Johnson, who is a Social Security policy analyst, another from the Senior Citizens League. They're both expecting the cost of living adjustment to be 2.7% next year compared to this year's 2.5% cost of living adjustment. Your thoughts?
My thoughts on... I was just trying to freshen up on CPIW and get a sense for... I don't have an answer, I'm sorry, for how much it deviates from CPIU, the traditional measure that
runs a touch under historically, okay. I believe, correct? Okay. Are you not looking at it right now?
No, I can't get the two series from the same data source to compare them. No, I'm sorry. Look, this is a good... I know it'll disappoint beneficiaries to get a smaller increase, but
this is bigger than last year.
To get smaller than they've gotten over the past few. I think people might be anchored to 3 or
sure.
4 or 5, but yeah, a couple tenths greater than last year.
Sure,
if present trends hold. But the lower the better for, I suppose, economic stability, like we were talking about in the last hour, because inflation is disruptive. It's disruptive to everybody. It's disruptive and jarring for seniors. It's disruptive, for retirement savers, for investors. It throws everybody's calculations off, which is why, as you put it in the last hour, people just hate it. each one of us for different reasons, I suppose.
And according to the Senior Citizens League, the average cost of living adjustment over the last 20 years is 2.6%. This is in line to slightly above that when you look at it. Folks, if you are trying to figure out what the picture looks like for you in retirement, including Social Security, the Armstrong Advisory Group has offices all throughout New England and can help give you some ideas about what your retirement can look like and discuss some different Social Security claiming strategies and how they could potentially impact your retirement. To schedule a time to speak with a member of our team, call 800-393-4001. That number again is 800-393-4001. Again, whether you're retiring this year, trying to plan for a retirement 5 years from now, or maybe you're already retired and trying to sort through some of these questions, Armstrong Advisory Group can give you a sounding board to help you make more informed retirement decisions. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Piece in CNBC, and this is not exclusive to them. I don't know where this was originally reported, but the headline is Trump considering 11 candidates for Fed chair, including David Zervos and Rick Reeder. To quote here, the new names include Jefferies chief market strategist David Zervos, former Fed Governor Larry Lindsey, Rick Reeder, the chief investment officer for BlackRock. Also on the list are Vice Chair for Fed Supervision Michelle Bowman, Chris Waller, Fed Vice Chair Philip Jefferson, Mark Summerlin, an economic advisor to the Bush administration, Dallas Fed President Lori Logan, and former St. Louis Fed President James Bullard. Are there any names on this list that you think are actually legitimately on this list?
I hope Zervos is on it. He's an original and interesting thinker, a legit researcher, a respect. And the reason I'm emphasizing these terms is that there's been some controversy over the president's BLS commissioner nominee for not having any publications, for not being a heavyweight. Zervos is, by distinction, or by contrast, a heavyweight. He'd be great. Reeder is not a heavyweight. He's a markets heavyweight. So I think it depends. Look, all these names are reassuring because these guys are their own men.
Let's take a quick break. When we return, we've got the trivia answer in Wall Street Watch.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network. A trust isn't just a document. It's a powerful tool that can help protect your assets from the nursing home and even reduce or eliminate estate taxes. Cushing & Dolan are leaders in elder law, estate planning, and asset protection. This month, they're offering a free guide called Demystifying the Top 7 Estate Planning Trusts. This guide breaks down the most common types of trusts, explains the pros and cons of each, and helps you understand which might be right for you and your family. Trusts come with different rules, benefits, and tax treatment, and choosing the wrong one could cost you. Learning the differences now can help you make smarter decisions for your future and your loved ones. Trusts are a critical part of any well-designed estate plan, but they can be complex. Don't guess your way through it. Get the facts first. Call Cushing & Dolan now at 866-848-5699 to request your free copy, or visit LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands. America's Caribbean paradise. Your holiday escape starts here at visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month titled Leaving a Lasting Legacy. Mike, one of the things that people have to navigate now is figuring out which accounts to leave to different beneficiaries. As an example, if someone has two children, one in a high tax bracket, one in a low tax bracket, how does that potentially impact who receives which assets?
Well, let's call it out. First and foremost, most commonly, people just divide equally. And there's nothing wrong with that. I get the fairness argument with all of this. But taking your example here, let's imagine we have one person with an average effective tax rate of 10% and another one with 25%. Obviously, there's going to be a massive difference in terms of what is left over with a traditional IRA, for example, for that person in the 25% bracket versus the 10%. And so with the new rules over the last few years when it comes to requiring those accounts to be emptied over the course of 10 years in most cases, especially on the retirement account front, there's a lot of different stuff that can be looked at there. That doesn't even take into account things like non-retirement accounts, Chuck, right?
Sure.
So for those, you have a different set of rules that applies to those, generally pretty preferential tax treatment. And so you can be really intentional about how you leave the biggest legacy possible to your heirs as a whole.
Folks, the guide is titled Leaving a Lasting Legacy. The way to request it is by calling 800-393-4001. Again, the guide is called Leaving a Lasting Legacy, and the way to request it is by calling 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Now it's 11:34, and your major markets are in the green right now. The Dow Jones is up 350 points, or 0.8%. The S&P 500 is up 12 points, or 0.2%. And the NASDAQ is up 23 points, or 0.1%. Fast casual restaurant chain Cava is down 16% after revenue came in at $280.6 million for the second quarter, missing the consensus forecast of $285.6 million. The company also missed expectations for same-store sales and lowered its forecast. However, Cava earned 16 cents per share in the quarter, exceeding Wall Street's estimate of 13 cents. Artificial intelligence infrastructure provider CoreWeave is down over 20%, despite it posting better than expected revenue for the second quarter. During an earnings call with analysts, the CFO said that revenue growth remains capacity constrained as demand outstrips supply. Circle shares of the stablecoin issuer are down 4%. Circle said it would offer 10 million Class A shares to the public, including 2 million of which would come from the company itself. Chili's parent Brinker International is up 0.7% on better than expected earnings beat for the fiscal fourth quarter. Brinker earned $2.49 per share, excluding items, on revenue of $1.43 billion. Hanes brand shares are up 5.5% after surging around 28% in yesterday's session. Hanes brand said it agreed to a $4.4 billion takeover deal by Canada-based Gildan Activewear. Palo Alto Network stock is up 1% on the heels of Deutsche Bank's upgrade to buy from hold. Deutsche said Palo Alto has solid core business and management. I am Ben Kitchen, and that is Wall Street Watch. And in our trivia question today, which actor portrayed General Leslie Groves in 2023's Oppenheimer? Well, that would be none other than Matt Damon. Matt in Concord, New Hampshire, is taking home our Financial Exchange Show t-shirt. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Mark, we got a bunch of stories in here on housing. One talking about how mortgage refi activity is picking up as rates went toward the mid-sixes from the high sixes. Another one, do you need to own a house? Many older Americans decide they don't. Another one from Bloomberg, Americans are getting priced out of home ownership at record rates. And another one here from the Boston Globe, so out of reach, Massachusetts has amongst the lowest young adult home ownership rates. I think all of these have one thing in common, which is ultimately that the cost of buying a house right now, especially when you factor in property taxes and insurance and utilities, is cost prohibitive for a huge chunk of Americans, and we don't have any way to fix that.
Well, I do, but it's not a pleasant solution.
I'm interested in hearing because I'm
called
a
a recession. Sorry. I shouldn't even.
That was your way?
Yeah, it's a recession. That's the only way I can come up with, Chuck. I'm not convinced it's a supply as opposed to a demand problem. These superficial explanations that only look at one side of the market, the supply side.
But you're just looking at one side of the market.
No, I'm suggesting it could be both. I did.
Gotcha.
Okay, I did just say it's a demand problem, Chuck, full stop. Forgive me. You are correct. Don't do what I just did. Don't look at just one side of the market. I think it's probably a combination. Look, go ahead. Sorry.
No, I didn't say anything.
No, well, I'm sorry. I saw something percolating up. I didn't want to not be.
You interrupted yourself.
Is that a first? I can do that. Yeah, well, I'm on medication for that. Apparently it hasn't kicked in yet today. You got to look at both sides of the market. I'm not denying so many people have chronicled inanely restrictive zoning regulations that are curbing supply. L.A., for example, sprawl is not natural. It's been dictated by, in retrospect, ill-advised regulations. But there's a demand part to this, I'll call it equation, too, and namely had a lot of stimulus, have had easy monetary policy. I would argue we still have monetary policy that may be too easy, though a recession would obviously override that for reasons we talked about in the first hour. So I'll say simply, and there's some research to back this up. I got scooped on this, not that I have the data to flesh it out rigorously. Other researchers in the past year have noticed that it is likely when you control for supply demand as measured by factors that could stoke demand, rising equity prices, for example, robustly rising incomes for certain income cohorts, something else we talk about a lot on the show, can explain a lot of the price rise in housing, too, the price increases in housing, which have been considerable, like 50% increase in the Case-Shiller home price index in the past, since 2021. I'm probably off a little bit on that time frame, but it's close enough. The largest increase since the so-called housing bubble. So I suspect demand has played a part too, and the next recession will wash out a lot of these excesses.
I guess my question on this, because that obviously, look, it solves the demand side of the equation if that happens, but obviously through something that's pretty ugly and uncomfortable. It's not a pleasant way to solve it.
No, you're right.
There's probably not a pleasant way to solve this on the supply side either.
Right.
But what we do know is that the answer cannot simply be, hey, here's more money to buy houses, because then you have more money chasing after the same number of houses. And I know what I would do if I were in the market to sell a place and all of a sudden there were something on board that is either, hey, here's, we're giving first-time home buyers $20,000 more to, free $20,000 to buy a home, or hey, here's, a way that you can decrease your interest rate by 2% if you're a first-time home buyer. I know the first thing I would do if that were the case is I'd say, great, I'm going to raise how much I'm going to, put my place up for, because I know that I have people coming in with either more money or lower rates than they do now. Like that's what I would do. I would raise the cost of selling my place.
Natural response.
It's the smart, logical thing to do is Okay, great. You're going to give everyone another $20,000? Fine, I'm going to raise my price by $20,000 in order to sell. Perfectly reasonable.
Yeah.
So it can't just be let's give people
terrible
more
solution,
money.
Right?
Building more. This is something that takes a long time to actually get to fruition, but it's probably part of the equation.
Sure.
But it also has to be, okay, if I'm going to be building more, how do I lower the costs associated with building? Because all else being equal, if I make it easier to build but don't increase the supplies of lumber, steel, garage doors, labor, like all the things that go into a house, all that's going to happen is, okay, we might get 10% more homes built, but at 10% higher cost, and now I haven't really helped anyone either in the short term because there still is enough demand to fill at those prices. So I think that ultimately we probably need a combination of a number of different things that we can do, but the answer is not going, it certainly is not going to be, hey, here's money so you can make a down payment, because all that's going to do is get absorbed into higher prices.
Yeah, that'll move the demand curve if you want to think about it in a supply-demand framework.
Which is bad. We don't want that.
The supply curve doesn't move. I say curve. You know what I mean.
Yeah.
You just said it. It's tough to increase supply. It takes time. So the easier thing to do, and is there any way to reduce demand that's humane? What would we do, like more government housing? Nobody wants to live in government housing.
That doesn't really reduce demand.
Well,
if no one lives in the government housing, then you've kept demand the same for everything else.
Darn it, you're right again, Chuck. I don't know. I'm being a little silly, but sorry.
No,
go.
Like when you say reduce demand humanely, you're like without like killing people and stuff.
Without euthanizing the economy.
Yes, or people, either one. Like it's not good. Like so here's the thing. When you talk about reducing demand for housing, for buying homes, one thing that you could do is make it cheaper to rent homes. If you think of it like kind of on...
Sure, it's part of the supply.
It's part of the housing supply, so how do we make it cheaper to rent versus
tax
buy?
Credits for rental, for multifamily building?
Whether it's for building or for rent. I mean, think of it this way. You have a mortgage right now. You can write off your interest up to, a certain percentage. You can't do that for renting. And the reason why is we want to incentivize home ownership.
Yeah.
Here's the humane way to reduce demand. Get rid of the mortgage interest deduction.
Yep.
Get rid of the mortgage interest deduction.
Yeah, never going to happen, but yeah.
The counter to that, I'm not sure that there's a big percentage of people that actually use it today because the standard deductions are so big and so many people still have relatively low mortgage. Like there are plenty of people that don't have enough mortgage interest to clear the standard deduction. But in theory, kill the standard deduction and...
Can you imagine even proposing that?
They already reduced it. I mean, not kill the standard deduction. I mean, kill the mortgage interest deduction.
Yeah.
I mean, look, they already put the cap in the 2017 law.
Yeah.
Lower the cap further. Yeah. Take the cap from, what is it now, like $750,000 in interest that you can deduct? Take it down to $500. I don't know, like things along those lines. That's probably the way that you can go about it. The problem is homeowners are not going to be happy because it reduces, the value of their homes. But ultimately, I don't think that the federal government should be in the business of trying to turn everyone's house into a savings vehicle.
They don't have the authority. Well, these days.
Which is kind of what we've done.
Yeah. And plus, these decisions would have anything to increase supply would have to be coordinated among a lot of different jurisdictions. So it just ain't going to happen.
It's all local.
You can't have national.
It's all local.
You almost can't have national housing policy.
You can't. But you can make better decisions locally. And generally, most people don't make great housing decisions locally, at least in terms of increasing supply, because we want to maintain our home values. Yeah. We don't want more kids coming into our schools. We don't want more traffic. Like you hear the litany of reasons.
Yeah, we're all
and
guilty,
it's really understandable why we generally don't build enough houses today.
Yep.
Quick break here. When we come back, we got, what do we call it? Stack roulette. That's it, right after this.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. When it comes to legacy planning, having a will is important, but it may not be enough. A will only covers probate assets, and the probate process can be slow, public, and expensive. That's where trusts come in. Trusts can help you avoid probate, keep your wishes private, and control how and when your assets are distributed. Whether you're looking to support family, minimize taxes, or prepare for the unexpected, a well-designed plan can make a meaningful difference. Our new free guide, Leaving a Lasting Legacy, covers wills, trusts, and other strategies to help you build a strong retirement plan. Take the first step towards clarity by calling 800-393-4001 right now and asking for your free guide today. That number again is 800-393-4001 or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing and Dolan know that no two families are alike, and neither are their estate plans. If you want a stress-free retirement, early planning is key. And for many, trusts are the tool of choice to protect assets and minimize taxes. But here's the challenge. There are dozens of trusts out there, revocable, irrevocable, and each comes with different rules and tax implications. From family trusts to special needs trusts, creditor protection trusts to charitable trusts, each serves a different purpose. Knowing which one fits your situation can make all the difference in your plan. That's why Cushing and Dolan put together a brand new guide demystifying the top 7 estate planning trusts. It breaks down the most common trust options so you can decide what's right for your family and your future. Call 866-848-5699 right now and ask for your free copy or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing and Dolan. Cushing and Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams, your rates will never increase, and your plan cannot be canceled regardless of your medical conditions as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
The Financial Exchange streams live on YouTube. Subscribe to our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you by the U.S. Virgin Islands Department of Tourism. 3 stunning islands, St. Croix, St. Thomas, and St. John, all just a quick flight away. No passport required, just sunshine, soft sand, and that warm island vibe. Craving a break? Plan your fall escape now and experience the beauty of America's Caribbean paradise, the U.S. Virgin Islands. Book today at visitusvi.com. That's visitusvi.com.
Mark, what do you got for Stack Roulette?
Bloomberg's top story right now is the Treasury Secretary urging the Federal Reserve to cut interest rates immediately by at least 1.5 percentage points. The point I want to make about this, because it's not something we talked about during the show, is that the haranguing of the Fed is really unproductive. It makes their job harder because it confuses all of us as to what the Fed's objective should be. You talked in the first hour about the 2% inflation target, which I think we all know now because of the recent inflation episode. I think if you ask the average person, is the Fed targeting 2, 3, or 4% inflation? I think the majority would say 2, again, because we're still shell-shocked by COVID inflation. We're now a bit confused. We don't know what the inflation fighting credentials, predisposition, commitment of the next Fed chair will be, because the administration doesn't seem to prioritize inflation over things like financing the deficit. This is what makes the current situation especially dangerous and precarious in terms of potential for an inflation breakout. Should we have another external shock of some kind, or should current underlying inflation remain elevated? Politicians, as we learned at great pain during the 70s and early 80s, politicians need to shut up, let the Fed do its job. And unfortunately, we're getting the exact opposite right now, which could mean more pain down the road.
Can we talk about just an interesting thought that I had pop into my head yesterday as I was heading home? It might not be useful, but what better group to talk about this in front of than like everyone listening all across the country? Like, it's a great place to workshop this and see if it makes sense. We talked in the first hour about how we've seen in the last few months a modest uptick in the inflation trend. Mm-hmm. Core CPI is now running 3.1. A few months ago, it was running 2.8. Mark, is I feel like I always ask you questions like this. You've said before, is the generally accepted wisdom when we talk about the shifts in inflation, it's not necessarily because of any one or two items, but it's a rise in the aggregate price level caused by a number of different factors.
I mean, month over month, it could be an extreme. When we see headline inflation jump, it usually is attributable to one thing. The problem is you can't reason from that to say, well, if we just get this one thing under control, inflation will be fine. That gets you into trouble because it ignores the demand, the excess demand that ultimately drives inflation higher.
So let me ask you this then, because this is just something that, again, started rattling around in my head. And if it's really dumb, then that's great. We can all learn that it's really dumb live right now. Is it possible that uptick in inflation that we've seen in the last couple months, despite showing up in tariff-related categories, audio-visual equipment, things like that, is it possible that rise in inflation would have shown up anyways, but just distributed differently if the tariffs were not in place?
The rise in core over the last few
years?
Yeah, I have to say it's my short answer would be, yeah, I could probably think of ways to get there, like mathematically. What worries me is the trend in inflation, which we talked about in the last hour. It has been and remains elevated.
I want to dig in on this a little bit more, though, because when we talk about that core inflation piece,
yeah,
is it possible then that we're all being head faked by the idea that, oh, this is tariff related?
Possibly, yeah.
When it's actually not, and it's just being drawn to those tariff categories now, but it's actually reflective of a broader inflation problem that wasn't completely vanquished in the last couple of years.
I think the evidence from measures that do a good job of filtering out outliers from month to month and therefore better reflect the trend in inflation supports your second explanation.
And so could it then be true? Again, I'm workshopping this very much as we go here. Could it then be true that, hey, maybe we do see just a one-time impact as a result of tariffs in some areas, but that overall trend inflation still continues to rise and be problematic because of underlying conditions there?
Well, if those price level changes, so quick inflation, no more inflation, if those feed back into expectations are a part of the trend in inflation, part of core, and I use core meaning the true core, not ex-food and energy like BLS calls it, then sure, yeah, I could think of a scenario in which tariffs feed the inflation process because the Fed always, by the way, can tamp down on it. It's just a question of do they want to sacrifice growth?
Of course.
So yeah, Chuck, I think everything you just outlined is plausible.
I don't know what to do with that, but I was just thinking about it.
Humility, I think, is the lesson.
I was thinking about it. A recent college grad asks, how do I compete with AI to get a job in finance? Got to be honest, don't know. Don't know.
Sorry, kid.
The AI is cheaper than you. The AI is faster than you. As a recent college grad, it's probably at least as accurate as you. I don't know how you beat it. And, like, that's kind of disturbing to me. And something that I hear from a lot of people in their early to mid-20s. Hey, I'm competing against companies that are trying to use AI that is pricing me out of the job market. Why did I just go to college for 4 years majoring in finance when there's no path to me being in that business? I don't have a great answer. I don't. Ben, are we done? Normally we hear... There we go. That's the one. We are done, and we're going to be back tomorrow. So don't worry. Tomorrow we do get some economic data. We got producer price index. We get weekly jobless claims. Yeah. And so we'll be talking about those plus Deere earnings as well. We'll have all that and more tomorrow on the show.